Hello, everybody. My name is Paul Buitink. Welcome to my podcast show. And today I'm going to talk to Lyn Alden, founder of Lyn Alden Investment Strategy. We'll be discussing what it means for the US to be the issuer of the world currency, world reserve currency, and to what extent other currencies, gold or crypto, can and will challenge that. Make sure to subscribe to my channel and put on those damn notifications. Otherwise, you'll still miss out on all my videos. Lyn, welcome. Great to have you on.
Hey, thanks for having me. Happy to be here.
Yeah, I'm really enjoying your research. I've been following you intensively over the past few months, and you're doing great work, especially when it comes to the position of the dollar, the whole macro fundamentals around the dollar, the euro, and all the other currencies, and of course gold and Bitcoin. So those are all the things I like and my viewers like. So great to be able to discuss that with you.
Yeah, I'm happy to
Um,
talk about them.
yeah, let's do some basics first because there's a lot of talk about the US dollar as the world reserve currency. Could you just walk us through what it means for the US to be able to issue the world reserve currency, and how has that evolved over the past few years?
Yeah, sure. So, it's often said that there have been previous reserve currencies, and that's mostly true. However, they're not really the reserve currency in the same way. So historically, it was really, gold that was kind of the real reserve currency. But there were some, currencies like the British pound that, were accepted very broadly. So they had kind of the previous mantle of, global reserve currencies. And especially, roughly after World War II, the United States dollar became the de facto world reserve currency. And that kind of took two forms. So the first form was the Bretton Woods system. And so, during and after World War II, the United States was kind of the big country left standing. So Europe was damaged by the war, Japan was damaged by the war, and the US was relatively untouched. And it was also, the largest creditor nation. So the US had owned more foreign assets than foreigners owned of their assets because they were like lending for the war and they were doing all sorts of stuff. So the United States was in a superpower position almost uniquely. And so uh, the plan at the time was that the dollar backed its currency by gold, and then other currencies pegged themselves to the dollar. So we had a lot of fixed exchange rates, and it kind of made for a pretty smooth system for a while. However, that started to break down after a couple decades because so much gold was leaving the U.S. because the dollar was convertible to gold, and we were printing a lot of money, and also there were foreign markets could make dollars essentially. They could lend dollars, and so the amount of dollars in practice expanded because of the whole fractional reserve system, and so more and more foreign investors wanted the gold instead of the dollars, and they started to basically call our bluff. And so Nixon closed the gold window, and that ended the Bretton Woods system. And then a couple years after, in the really early 1970s, they established what is essentially a petrodollar system, or the dollar in some ways backed by oil. And the way that works is that the United States made certain deals with certain countries so that they only price their oil in dollars. So even if a European buyer buys from, say, Saudi Arabia, they're paying in dollars, which is neither of their currencies. And so for almost 50 years now, the United States has had a pretty hard lock on virtually all oil pricing globally and many other commodities. And that's what kind of makes the global reserve currency, is the idea that nations around the world buy commodities, particularly oil, in dollars. Now that's starting to change somewhat. But that's historically, kind of the status. And because of that, countries around the world hold treasuries in their foreign exchange reserves so that they always make sure they have dollars on hand.
Yeah,
And that
and
that
like roughly 20 years ago, I think 17% of all official foreign reserves was in dollars. Now it's 60%. So
yeah
so there's a move towards more diversification. Do you
yeah
believe that trend will intensify the coming years?
I think so. And there's a couple reasons for that. So after World War II, the United States was almost 40% of world GDP because, like I said, we were the most untouched by the war. And over time, as Europe and Japan recovered, and then as we've seen the rise of China and other emerging markets, the United States is an increasingly small percentage of global GDP. We're still a very large percentage, but it's now closer to 20%. And in purchasing power parity terms, it's actually less. It's in the high teens. And now China is the biggest commodity importer instead of the United States. So it's very hard to price all currencies in the dollar when the U.S. is not even the biggest importer of commodities anymore, and when we're an increasingly small share, still a large share, but a smaller share of world GDP. And we're starting to see, for example, Russia's looking to price its oil in euros. We've seen China and Russia between themselves drastically reduce their dollar-based trade in the past 2 years. And so we're starting to see kind of a fracturing of the long-term system, and we're starting to see a little bit more currency diversification happening.
Yeah, you're an American, if I'm not mistaken.
Yes.
Do you think it's a good thing, this
Counter
trend?
Counterintuitively, yes. I think it's one of those things where it's got to be done eventually. So it's not going to be pleasant for a lot of people, but it depends who you ask. And this goes back all the way to Triffin's dilemma. So back when they were doing the Bretton Woods system, there were some economists like Triffin and Keynes that argued against having the dollar at the center of the global financial system. And that's because if you do a system where dollars are used internationally for trade, and pretty much all countries around the world have to use dollars to buy oil, that creates a lot of demand for the dollar. And that sounds like a good thing, and at first it was. But the way that most currencies work is that if a country produces more than it consumes, it has like a trade surplus, and so that usually makes its currency stronger and stronger, and that tends to make its exports less competitive and increases its import power. So over time that often kind of normalizes, unless they do kind of currency manipulation to try to weaken their currency. On the other end of the spectrum, if a country's importing more than they're exporting, they develop a trade deficit, and usually when a recession comes or some other kind of catalyst, usually they have a pretty significant currency devaluation, and it's painful, but then it makes their exports more competitive and it reduces their import power, and that helps them kind of normalize and start building up from there. The US never really gets that corrective cycle. So our currency is we're always pretty much always running big trade deficits, and in order to be the world reserve currency, you kind of have to do that, because it's not, the whole world can't buy oil in dollars if there's not enough dollars out in the world, right? So we have to supply a crazy amount of dollars to the rest of the world, and that was started at first intentionally with the whole petrodollar system, but it becomes self-perpetuating because now there's so much dollar demand out there, that it keeps our dollar price pretty strong, and so we have a lot of importing power and very weak exporting power.
Yeah.
And as a result, we've exported our supply chains, our industrial base, more so than several other developed countries like, say, Japan or Germany, that still have strong industrial components. We've really kind of focused on the service sector and exported a lot of our blue collar work. And so it's been a case where there are some percentage of Americans that have really benefited from this, like the upper echelons of wealth, essentially, whereas the middle class, the working class in the United States hasn't really benefited from this system. And so now that we're almost 50 years into the system, we're kind of on the wrong side of Triffin's dilemma. So, back when it was started, it was kind of exorbitant privilege to be able to basically print money to buy commodities. But now we're kind of paying the cost of that because we've exported so much of our manufacturing base to not only to China, but also, Europe has a trade surplus with us. Japan has a trade surplus with us. We're just quite uncompetitive in terms of physical products.
Exactly. So rather than a blessing, it now turns out to be a curse, for many people, at least in the US.
Yeah. Yeah.
Yeah. And how important is it that the US has such a strong military, and to what extent does that support the role of the dollar?
Oh, that's been a very strong part, because part of having the global reserve status based on oil is that we have the widest reaching navy, and they use that navy to protect a lot of oil's transportation lanes around the world, particularly around the Middle East. And it's also it's part of the reason we've been so entangled in the Middle East in terms of conflicts for decades, is to basically kind of keep enforcing U.S. hegemony over oil pricing and oil supply, oil transportation, things like that.
Exactly. Okay. And China has been voicing more and more discontent with the current situation. Recently, the China's banking watchdog Gu Chuging, I'm not sure if I pronounced that correctly. He stated in an article in the Communist Party's Quishi magazine that in an international monetary system dominated by the US dollar, the unprecedented, unlimited QE policy of the US actually consumes the creditworthiness of the dollar and erodes the foundation of the global financial stability. Do you agree with that statement?
I think so, and China's been slowly kind of removing themselves from the dollar system. Not as quickly as say Russia has, but they've been very slowly decoupling themselves. And the way that they did that was historically countries that run very big trade surpluses with the U.S. So they collect a lot of dollars, but then they reinvest a lot of those dollars into treasuries and they store them as FX reserves, and that it funds our deficits, and so that's kind of been this process. Now about I don't know, 6, 7 years ago, China, essentially stopped reinvesting their dollars into new treasuries, and they started basically buying hard commodities. They started lending to countries around the world, and having stakes in all sorts of infrastructure and mines and ports and things like that. And so they've basically been, kind of taking on some of the weaknesses of the current system and kind of using it against us. And so that's another reason why that this system is no longer really serving not just the United States, just the whole system's not really, kind of durable. And the thing that really hurts international markets, we already kind of covered what hurts the U.S. markets. The thing that hurts international markets is that, when many, especially emerging markets, but also it even is kind of a big thing in Europe and Japan, that there's so much lending that's based in dollars. So many companies around the world, and then some governments around the world have dollar-based loans. So they owe debt in dollars, which is a currency that they cannot print. And that's why we have this classic emerging market boom bust cycle, is because they experience recessions far more heavily than developed markets because their dollar-based debt is a larger percentage of their GDP. So they kind of undergo quantitative tightening essentially during recessions because their debts go up because the dollar often strengthens compared to their currency, and many of them have currency crises. So if you look back over the past 50 years of the petrodollar system, there have been three really big spikes and troughs in dollar strength relative to other major currencies. So the first one was in the 1980s, and when we had that big dollar spike, many Latin American countries had all sorts of economic and currency crises because of that. And then we had another one in the late 90s, and so we
Asia.
had so we had Southeast Asia have trouble, we had Russia have trouble, and then the third big spike is happening pretty much now, ever since 2015. And so of course we've seen Turkey, we've seen Argentina, we've seen to some extent Chile, we've seen a number of emerging markets run into again dollar-based problems. And so this boom bust cycle really hurts the whole kind of system. It makes a lot of fragility to it. And then for the U.S., as I covered, we've benefited in some ways, but especially for our blue collar workers, we've really exported a lot of our production capacity.
Yeah, and we saw in March that a lot of emerging countries they needed, and companies in those countries they needed dollars, so they were starting. They sold their treasuries also. So we had the
Yep.
Fed to buy those treasuries. Otherwise, yields would have gone up
Yeah.
like crazy. So
Yep.
how do you see that dynamic going forward? Because dollar has weakened over the past few months. If I look at the dollar index, the treasury the treasury is going to issue much more debt going forward because of all the new stability measures that are going to be approved most likely. How far is the Fed going to expand the balance sheet? Basically, that's my main question for now.
In the years ahead, I think it's going to be very large because they're a significant buyer of large U.S. deficits. There's not a lot of buyers because international sources haven't really been buying over the past 5 years. Domestic sources are kind of already full with treasuries. So the Fed is now one of the primary buyers of treasuries. In the near term, it's trickier because so we had the very large stimulus earlier this year, and the Fed purchased a lot of it. Currently, there's some fiscal gridlock. The two parties here are kind of debating what to do for the next round of stimulus. There's all sorts of political issues tied into it. So it's unclear when they would pass that next one. So in the near term, there's some disinflationary pressures because all the stimulus checks that were going out to people kind of came to a stop. People are having trouble paying their rent, paying their necessary expenses. Small businesses are more in trouble. So a lot of those kind of free money bailouts that were happening earlier this year are currently shut off. Now, I think we're going to see kind of more of that in the coming years. We're going to see more stimulus because if they don't, we're going to have more civil unrest and things like that.
Yeah.
However, it's not a smooth process. There's going to be these gridlocks, and then something usually forces them to get it through. So, for example, they passed that historic stimulus during a market crash. So they had all that pressure on them. But now with markets back up, things at least on the surface appear smooth at the moment because we're still kind of surfing on that previous stimulus, and we haven't had the full effects of it coming off yet. So they don't seem to feel a lot of pressure at the moment. But either a stock market correction or more civil unrest, things like that, eventually spur them to do another round. But the timing of that is always uncertain.
Yeah, exactly. And but if you look at the Fed now, they own around 16% of all the U.S. Public debt, which is still not much compared to other central banks, right? So there's enough firepower left for the Fed to buy treasuries.
Yeah, I think the Fed is going to end up owning a much larger and larger share of U.S. Treasuries over the next, call it 5 years. I think this is a pretty long-term situation. The United States has some differences compared to a lot of the other central banks that own a lot of their own debt. So, for example, if you look at the Bank of Japan or the ECB, those economic blocks they don't really have the same trade deficits that the U.S. has. So, for example, Japan has a roughly balanced trade situation. They have a positive current account. Same thing for the Eurozone. And Japan has a very positive net international investment position, meaning that they own a lot more foreign assets than foreigners own of their assets. It's actually it's something like positive 60% of their GDP. And Europe, from memory, is a little bit, it's more balanced. They roughly own about the same number of foreign assets as foreigners own of their assets. The United States is on the other side of the spectrum, where foreigners own much more of our assets than we own of their assets, and it totals about negative 50% of our GDP. So the last numbers were foreigners own about 40 trillion in U.S. assets, and the Americans own about 29 trillion foreign assets. So we have a 11 trillion deficit in terms of how that works. And so that dynamic kind of sets a floor for Japan's currency and to some extent the euro, because they both have positive current account balances and a lot of kind of assets, and so there's kind of a steady stream of wealth flowing into those areas, and so. Whereas the U.S., we're flowing out that way, but investments are flowing into us. People are often buying our stocks and stuff. So if that reverses at some point, then we could see a more significant dollar decrease.
Yeah, and then also an accelerated increase of assets on the Fed balance sheet. Then that process would go faster than expected, or because there's still, of course, a room for them to scoop up most of the debt, right? That balance sheet, of course, it will eventually probably lead to inflation, but how much space do they have without creating inflation, you think?
That depends on what kind of spending that fiscal authorities do. So a lot of people, for example, thought that the 2008 crisis would be inflationary because that's when they first started this big wave of quantitative easing. However, not a lot of the money got out into the public. So a lot of that money went into recapitalizing banks. A lot of it wound up in asset prices. So we had, you could say it's asset price inflation, but it's not really a ton of consumer price inflation, at least in certain areas. However, what makes this recession different is that a lot of these stimulus measures, it's going out into the real economy. So it depends. Every country's different. Here in the U.S., everybody got $1,200. Well, most people got $1,200 stimulus checks, and we sent $500 billion to small businesses in the form of loans that turn into grants. So most of them are forgiven. We've done corporate bailouts, and people that were unemployed were getting $600 a week in extra unemployment benefits from the federal government in addition to their state benefits. So yeah,
But the
it's
velocity
definitely,
remains low, right? So it's not really yet translating into consumer price inflation or
yeah.
lots of purchases.
Not yet. So we've seen some of a bifurcation. So for example, food prices, all these essential spending like healthcare, food, that's continued to go up at a pretty rapid rate, something like 5%. On
Right.
the other hand, discretionary goods are obviously prices are weak in those areas to some extent. There are some pressures. So essentially, if they keep up large stimulus, it can basically offset the deflationary shock of the recession and be somewhat more inflationary. We've seen kind of a rebound in inflation expectations by the Treasury market. There's a couple other forces. Of course, technology is very deflationary. On the other hand, we've decreased inflation in the U.S. and many other places by outsourcing a lot of our production to China and other places. And that's lowered costs, but it's also shipped away jobs. There's more of a political kind of uh, thing brewing over the past few years. Back to the whole Triffin dilemma, the whole dollar, offshoring our manufacturing. There's been kind of a political push to bring some of that back, either for strategic reasons, because we saw during the crisis that we don't make our own masks,
Yeah.
we don't make our own medicines, or for political reasons, in the form of jobs and things like that. So if we have a trend where we stop outsourcing, an increasing share of our production, and we start either flatlines or reverses to some extent, that could be somewhat more inflationary because it would essentially increase the production costs. In terms of better resiliency, more jobs here, it also makes goods somewhat more expensive. So I think we could in the future see some inflationary pressure.
Yeah, but that sounds like Trump's agenda also, to
Yep.
a large extent. So do you agree with most of Trump's policy measures?
I think it's long term, it's a good idea to bring some of these jobs back. I think that Trump is not necessarily focusing on the root cause, but I think that's not a Trump unique thing. That's a U.S. policymaker in general are doing that, and that's because in general, U.S. policymakers want to have the global reserve currency, but they also want to bring a lot of jobs back and reduce our trade deficits. But those are kind of mutually exclusive goals. They'd have to really restructure the way that the global monetary system works in order to sustainably bring a lot of jobs back. And that doesn't mean that the dollar becomes not a global reserve currency, but it more means that the dollar becomes not the only global reserve currency. It becomes a global reserve currency along with some other major currencies. And essentially, what happened now is that the U.S., as we talked about before, is a smaller and smaller share of global GDP, and it's no longer really big enough to be kind of the only currency that all commodity pricing happens in worldwide. And we've had to pay a pretty big price for this, which doesn't really have a lot of runway left in terms of increasing more and more jobs overseas. So, one way to kind of improve this, people always ask, if the dollar is not the reserve currency, what would be? Would it be the
Exactly.
euro? Would it be the yuan? But I think it's sort of the wrong question, because there's currently no country big enough. There's no country that looks like the United States looked after World War II. There's no country that's 30 or 40% of world GDP, and instead it's more about, I think, going forward, kind of a multipolar system. So instead of one currency being used to price all commodities, I think we're going to see top 3 or 4 currencies having that role.
Yeah, but other people say it's money is all about network effects, and it's in that sense people desire one currency globally to price things in, and the dollar happens to be that currency, and that's why it's so difficult to get rid of that status. Does that argument also holds value?
Oh yeah, definitely. So there are strong network effects because we previously talked about that a lot of countries have dollar-based debts, right? So that doesn't just that's a like a cruise ship that turns very slowly. That's not something that switches off overnight. There's so much that, because all of that debt internationally represents demand for the dollar, because they need dollars to service those debts. So even if they want to eventually diversify their currency debt exposure, they still have to service and then eventually pay off their U.S. dollar-based debts. So that alone is a very strong network effect, let alone just tradition and kind of political ties in terms of what currency is used. Now, there are some countries that have a stronger incentive than others. So, for example, Russia has been kind of leading the way towards de-dollarization of their own, uh, uh, basically internally and with some trade partners. And then now we've seen China has moved slower, but they're starting to accelerate that a little bit, especially with Russia. And so, you know, basically it's one of those things, like, you don't change until you have to. So changing the global reserve currency is extraordinarily difficult. But because it's kind of at a breaking point now, both for the U.S. and for the many other places in the world, it's starting to happen a little bit faster, it seems. And it's still going to be a somewhat gradual process, most likely. But it seems that the world pretty much mathematically has to move to more currencies able to buy commodities.
Yeah,
And you can use, yeah.
it's interesting that Russia, for example, they of course they dumped already all their treasuries, if I'm correct. And I also read it in China that China wants to, whenever they fund African countries, for example, in the Belt and Road Initiative, they would like to push for renminbi loans, but in the end, those African countries say, well, please dollars because that's more fungible and that's more liquid. So we prefer
Yeah.
dollars. So in that sense, we're all stuck with even though, and those are countries then, China, African countries that have business amongst themselves, and they still have to use the dollar because that's basically what the market demands. And but I hope that can change. But do you think it will be an evolutionary process, because you said gradually, or will it be something more revolutionary, or with a shock, or possibly even a more intense conflict, even war? Is that something that's likely too, in your view?
So my base case is gradual within the possibility of big stepwise changes. So there could be kind of Plaza Accord like changes that kind of do something more abrupt, especially if it continues to be hard to change. However, over the past 2 years, it's been pretty gradual. So we've seen like Russia and China, de-dollarize a big chunk of their trade, for example, and it mostly comes down to some individual trade agreements. Even between Russia and India, there's been a little bit of kind of increased local currency transactions between the two. And so it kind of comes a question about if that continues as it currently has been. I think it will. I think we're going to see, kind of a chipping away at the current system. And even though the current system is still very strong, it's one of those things that takes time. Yeah.
Yeah, and what's the role of gold in that constellation? Is gold going to be more of a official reserve asset for many countries? Of course, a lot of central banks have already been accumulating over the past few years, but do you expect gold to play a more formal role, possibly within the IMF or within the SDR?
So I think so, at least in terms of central bank holdings. So if you look over the past 5 or 6 years, foreigners as a whole, their foreign central banks stopped accumulating treasuries on net. So they haven't really increased it in 5 or 6 years, but they have mildly increased their gold. And especially some countries like Russia have strongly increased their gold. So Russia, as kind of the model of rapid de-dollarization, they've also been buying gold hand over fist. Even right through the they had a recession in 2015, 2016. They kept buying gold through it. So instead of decreasing their FX reserves, they were still buying gold.
Smart move
Uh,
in the end.
yeah, yeah, it did. So far it's done very well. And for example, in this current crisis, so oil fell off a cliff, right? So that hurts Russia because they're a big oil producer. However, their FX reserves went up because a lot of it's priced in gold, and all of that appreciated in price. So we have seen kind of a move towards gold, and that kind of makes sense if you look at it in terms of you know currencies are kind of shifting more and more towards medium of exchange in that sense. So currencies are used around the world for transactions, but then central banks ultimately want to store something that has less counterparty risk and that has kind of an inbuilt inflation adjustment to it in some sense. So I do think gold is likely to continue to play a pretty large role for central banks, and probably an increasing role over treasuries.
Yeah, and in your investment advice, what's the percentage that you advise people to have gold in their portfolio?
I think it varies. I don't give a specific percentage because each person is different. Whether they want to store physical or ETFs or miners, there's different kind of approaches. So I don't think there's any one size fits all percentage.
Great. And finally, crypto, and you've also been very interested in that sphere. Do you follow a lot of crypto projects, or do you focus on just a couple?
So I follow the space to some extent, but my primary interest has been in Bitcoin as an investment.
Yeah, and why only Bitcoin?
It has very strong network effects, mainly kind of the same things we talked about the dollar. So the Bitcoin was the first cryptocurrency. It has, it's the most kind of hard in the sense of being hard money. So there's a lot of other interesting projects around the space. But for my specific investment thesis, Bitcoin is the way I'm playing it because it tends to have its price action tends to be uh, has a pretty consistent pattern built around its 4-year halving cycle. And so at this stage, I turned bullish in April of this year, and I continue to be bullish roughly to the end of 2021 or so. I'll see roughly where that ends, but that's kind of my time frame for this particular outlook.
Do you expect central banks or other official institutions to start accumulating Bitcoin at any point soon?
I think it's possible in the future. So right now, Bitcoin is still a pretty small market cap on the global scale. So its market cap's somewhere over 2 billion, 200 billion last I checked, whereas the estimated gold market cap is somewhere around 10 trillion, right? So it's a small market cap in terms of kind of its use in central banks. Now, I do think you could start. We're actually starting to see, for example, companies. I know of 2 cases now of companies that have converted some of their cash into Bitcoin, and so I think we could see that trend play out a little bit more. And then I do think, especially some central banks that are looking to de-dollarize, I wouldn't be surprised to see them eventually have a non-zero Bitcoin position. I don't think it's guaranteed, but I think that the way that the game theory works, I think some of them might get into that to diversify. Historically, they don't like silver too much because again, it's not a huge market, and also because it's not very efficient to store at scale because it's a lot less expensive per ounce than gold. Whereas Bitcoin, if it can be pretty effective to store that pretty easily. So I do think that we could see some of the more dollar antagonist nations potentially have a non-zero Bitcoin position in the future.
Interesting, yeah, and especially smaller central banks, I would argue, then.
Yeah,
But they would have an incentive to be very public about that in order to also boost the price in their reserves.
maybe after they establish a position.
Yeah, of
That
course.
I
Yeah,
think, yeah,
yeah,
I think that there's some people, for example, that theorize that China's gold holdings are much larger than they state, because if they suddenly state that actually we own far more gold than we said, that probably would be pretty bullish on the price. So I think that the any country that kind of accumulates Bitcoin would have an incentive to maybe not say it right away.
yeah. Until they've reached the position that they're comfortable with.
Yeah.
Yeah, yeah. You should never announce in advance, like Gordon Brown did, announcing that he was going to sell gold, and then the price crashed, and then he sold at the bottom. Yeah, interesting. And where can people find you online, and how can they subscribe to your newsletter? Because they're gems, and they're long and very dense and full of interesting charts and numbers. So I definitely advise people to follow you. Where can people follow you?
I appreciate that. So yeah, I run lynalden.com. So I have a free newsletter. I also have a low-cost paid research service, and then I'm active on Twitter at Lyn Alden Contact.
Yeah, perfect. I'll put all the links in the show notes. It was very interesting. Anything else you want to add to the conversation, or things we need to take into account going forward with everything that's going on?
I think we covered things pretty well. I think it just pays attention to keep watching developments in kind of commodity pricing, potentially in other currencies. I think a thing to watch over the next few years is trade between Russia and China to see if that continues to de-dollarize or if that kind of hits a plateau at some point. So I think these next few years are going to be pretty instructive, and it pays to kind of just follow the trends rather than to have a firm outlook of what's going to happen. Have a framework, understand the bottlenecks, like why things kind of eventually have to change, but then be flexible in terms of kind of anticipating how quickly things will change or in what direction, because
Yeah.
no one can predict it all in advance, but you can have an idea and then follow things as they happen.
And what's the single most important number that you check on a daily basis? Like if you wake up and there's one metric you want to know, what's that metric?
I usually check the dollar index.
Okay, good to know. Thanks, Lynn.
Yeah.
Have a good day.
Yep. Thanks for having me.